Okay, we'll start now, yeah? Okay. So, good afternoon, ladies and gentlemen. Welcome to Siloam's FY2022 earnings webinar. My name is Willy Chandra. I'm the Investor Relations Senior Officer of Siloam. And today, joining us here in the webinar is Ms. Karen Reddy, Deputy President Director of Siloam, Mr. Farun Khanna, Managing Director of Healthcare Business and Investment, and Mr. Daniel Phua, Siloam's Group Chief Financial Officer. This webinar will be moderated by Ari Jahja from Macquarie Securitas, and we're live again at Siloam's Motaria Comprehensive Cancer Center, Indonesia's premier hospital for cancer treatment. And we're also delighted to have the esteemed sell-side analysts of healthcare in Indonesia. And I would like to thank the following analysts for joining from Mandiri Sekuritas, Samuel Sekuritas, Bahana, BCA Sekuritas, and ARHB. Thank you all for coming. It's a pleasure to welcoming all you here. And Ari, the floor is yours.
Thank you for the intro, Willie, and welcome to all participants joining here and through the online method as well. So today's call will have two sections. First, Siloam will be providing their brief on the results, followed by the Q&A between myself and management. And after this initial Q&A session, I'll open the questions to the floor here in person and also online. And for those of you who will be asking questions in the room, please also state your name and the company you work for. And those who are joining online, feel free to ask in the chat box in your screen. I will then ask your question to the management. So without further ado, let's start the session here today. And firstly, I'll ask Daniel, who is joining us online, to provide a brief highlights on the financials and operational results for the fourth quarter 2022. Over to you, Daniel.
Thank you, Ari. Really, if possible, can you allow me to share my video, please?
Yes, but I'm on it.
So welcome, everybody. Thank you, Ari, for the introductions. Before we go into Q&A, I will take you through the presentation deck. Willie, will you be sharing or would I be sharing?
You can share, Pak.
Okay. Okay, the system is just loading. Please let me know if the screen is already visible. I think it is still loading.
It's still loading, Pak Daniel, unfortunately. Yep, we can see the screen now.
Okay. First of all, we've had a very strong results for FY 2022. But if we look at the revenue, EBITDA, and net profit, basically they were all flat compared to 2021. Keep in mind, though, 2021 compared to 2020, there was a close to 60%, over 60% growth, in EBITDA alone. And a lot of that was driven by COVID. So the fact that in 2022, without COVID, we were able to maintain pretty much, if you can look at it, EBITDA at a 2 trillion level, which is, as I mentioned, flat compared to the year before. And this is as a result also as an improvement in EBITDA margin. EBITDA margin in 21 was 25.7%, ending up at 26.8% in 2022. But net profit also improved slightly. We ended up at 710 billion compared to 700 billion the year before. As I mentioned before, I mean, if you look at it, this is the revenue. The fact that we were able to maintain that compared to FY19, the pre-COVID level, this represents a CAGR of 12%. Yeah. And if you were to look at the CAGR for EBITDA, let's say over the last 2 years, from 2020 to 2022, it will be something close to 40%. This is definitely helped a lot by the recovery of the base case. As you can see, with regard to the percentage versus January 20th as a proxy for pre-COVID level performances, as of December 22, we are over 30% higher in comparisons. And you can also see very clearly that quarterly, there's been quarterly improvement in the performances as well, coming out of the post-COVID era. In 2Q22 to 3Q22, we posted an improvement of close to 40%, as you can see, in regard to the EBITDA. We reported a margin of 29.4%, and that was largely maintained coming into 4Q 2022. I think back when we presented the 3Q22 results, the market did have questions about, how much of that was due to pent-up demand and so forth. The fact that this performance was maintained into 4Q 2022, I think for us as managers as well is further affirmations that this should really be the stable state going forward. We do see that the performance are maintaining is improvement track in the 2023 as well compared to 2022. The EBITDA margins were helped a little bit by obviously the payment of KMK. We've made certain provisions for the COVID revenue due to the uncertainties. And as some of these payments are being made towards the end of 2022, some of those provisions get reversed that help with the margins. But even if we were to exclude those upside, the margins would still be above 25%, in line with the guidance that I've given you previously, that is the target that we'll be aiming for with regard to our EBITDA margin. Operational results similarly has shown a robust improvement. 2Q to 3Q obviously had the strongest jump coming out from the Lebaran period to a post-COVID recovery period. But you can also see that from 3Q to 4Q, I mean, the performance improvement has been maintained as well. Yeah, so we are seeing Q-on-Q improvement coming out of the post-COVID, post-Lebaran period as well. Similarly, occupancy rate has improved to sit at 65.2% as at the end of Q4 2022. Inpatient visits and outpatient visits, as you can see, similarly, Q-on-Q, 4Q upon 3Q has continued to see improvement. And we are seeing this trend continuing into 2023 as well. If we were to look at the historical results, I mean, certainly the outperformance of Siloam, I do believe, is significant. Revenue grew by 13%, and when you filter that down to EBITDA, that is a 25.9% CAGR. Net profit is 128.6% CAGR. OCF is a 68.7% CAGR. It does mean that what we grow in top line does get carried down to the bottom line as well. As you can see, the EBITDA margin has also improved year on year to end at this year, whereby we are at about 26.8%. Operating cash flow, as you can see, has also improved. 2021 was aided by a lot of back collections, but we see that that was maintained going into 2022 as well. Other key items to highlight is that management has been very diligent in trying to improve its margins, as you can see, I mean, from the results. At the same time, working capital has also seen significant improvement. In FY 2021, the working capital days was sitting at 37 days. Currently, it is now sitting at 12 days. We are continuing to make improvement in these areas as well. And we do believe that there are further avenues for improvements, and therefore you will see improvement in operating cash flow as a result as well. Some of these efficiency measures that management has undertaken, but I mentioned some of this previously, including relooking at how we look at material cost savings, how we look at procurement practices, how we look at, for example, we've renegotiated our hemodialysis contract, and all of that had contributed over 840 B in savings, annual savings, for the next 5 years. So this, we believe, would continue to bring benefits to the margins of the business, and we'll continue to see improvement in both EBITDA and NPAT as well as a result. Finally, on the dividends, for 2022, we are proposing a dividend of 255 B. That is sticking with the payout ratio of 36% from last year, so consistent payout ratio, but is 5 B higher than last year, obviously due to the slightly higher NPAT. Again, look, all things considered, we would strive to maintain our payout ratio at the level that the market has been used to seeing. And this provides obviously a dividend per share of 19 rupiah per share at the dividend yield of 1.5%. That's all from me with regard to the financial and operational performance update. I would hand the time back to Ari for Q&A. Ari, you're on mute.
Can you hear me?
Yes, we can hear you now.
Okay, great. Okay, thanks for the update, Daniel. So we're going to kick off the Q&A session here. So my first question in regards to the margins, right? Certainly we see an impressive resiliency in margins in 2022. So basically, how much do you attribute this with that COVID benefit and without COVID?
Well, with regard to the 2022 performances, Ari, as you can see, we were actually negatively affected by COVID, in 2022. And I think I've highlighted this in the previous earnings calls before as well. Because in the Q1, the Omicron affected a lot of a lockdown and people not going out. But at the same time, the hospitalization rate, thank God, was very low. And therefore, actually, in the Q1, revenue EBITDA actually went down compared to before. So the recovery really happened towards Q3 and Q4. And Q3 and Q4, COVID made up, in Q3 is about 3%, in Q4 is about 2% of our revenue. So basically in Q4, there is practically no COVID revenue at all. Therefore, the way you should look at it is that base case is 100%, I guess, the drivers for our revenue performances in 2022.
So basically, following the impressive margin in 2022, how should we think about the EBITDA margin trajectory for 2023?
Currently, I think I maintain my guidance of 25%. As you can see, there certainly we have done better this year, and we do strive to do better for 2023 as well. But I think if you look at what happened in the past, I've always tried to outdo, what guidance we've given to the market. And on that, I think we will stick with that position right now. For the time being, I think I will stick with 25%. It will very likely be higher than 25%. But I think at this stage, I will just stick with that guidance for the time being.
Got it. So there's a conservative element there. Any color in terms of the revenue growth expectations?
I think the revenue growth would definitely be double digit. But we obviously have a few tailwind that is helping the BBGS tariff adjustments and so forth. So we do believe that the revenue growth should be a double digit.
Got it. Makes sense. And in terms of the trends on the patient volumes year to date, you mind sharing some color there?
Patient volume, I mean, we are still not 100% back to the pre-COVID level with regard to throughput. So we do believe that there are certain room for growth in there. I think the 3 to 5% improvement that you see Q on Q, we should expect that to continue going into 2023 as well.
Got it. So basically, if we to think about the the double-digit revenue growth, it will be sort of more driven by the uptick on revenue intensity and price hikes compared to volume growth. So how should we think about it if you look at the double-digit top-line breakdown?
We'll probably address that further down in other questions, but I would say both. It will be driven by both the revenue intensity and also in the growth in volume as well. But as we said a few times, as the strategies for Siloam is definitely to focus on building up its center of excellence, in building up its equity and the average revenue per occupied beds that currently we are a leader of. It is certainly something that we have not changed in terms of the thinking and the strategy. So the operational bed will grow. I mean, looking at occupancy for beds for hospitals and so forth. But I think the growth in revenue intensity will be high.
Dan, let me add a few things to what you've said. Ari, Q4 this year was the first time where volumes were higher than Q3. And generally, the industry does not see that. We are no exception. If you see our performances in the past, our best quarter in a year turns out to be largely Q3. This time, we've ducked the trend, as Daniel presented, both on revenue and EBITDA, and which is all being driven by better operating metrics. Now, as we get into, we generally take a conservative approach. That's the best thing in our industry. But as we get into Q1 of this year, we've not seen that taper down. So we are now starting the year as opposed to last year. Last year we started the year with about a 50% occupancy. This year we've started the year with about a 65% occupancy with number of beds not having gone up. So that should give you a sense that from operating metrics standpoint, which is the number of patients that we are serving largely, we've had a good start to the year, and that should flow in, as third and the fourth quarter generally tend to be better than the first and second quarter. Dan, back to you. Thank you.
Thank you very much.
Daniel and Varun. And then in terms of the kind of the payer mix, right? Do we see any further uptick from the corporate clients, which has been basically been very strong for Siloam in the past few quarters?
It's a good story. Ari, we've been mentioning about it for the last 3, 4, 5 years. We continue to have 80% of our revenues come from out-of-pocket, corporate, and insurance business. We've retained our share of BPJS because we want to serve the BPJS community as well. I think, and we've believed this now, that this is the right mix to have, and we shall sustain it. What we are realizing is that our growth rate on account of corporate and insurance is actually far more robust than any other category. So we still continue to grow higher than the blended growth rate on both our corporate and insurance businesses. That's also driven by the insurance industry at large. We've given you the sense earlier. From our 10, 11 million insured people, the country is expected to get to 17 to 20 million insured people over a period of next 4 to 5 years. Needless to say, that will become a fairly vast segment for us as we go forward as well. Other than that, we've also seen a lot of OPE patients come on account of embassies, on account of patients who would travel abroad previously, and on account of a very huge upside that we see in the Bali market. All of these 3 reasons have led to our OPE business continue to grow as well. So from a payer standpoint, I think with the 80-20 mix that we are currently hovering at, it seems to be pretty nice and very healthy for our margins.
Got it. Thanks for clarifying there, Varun. And also another catalyst on the BPJS side would be the recent tariff increases. So how do Siloam see the implications from that?
So it's early days. We've been doing our maths around it, and we are very happy and positive with the endeavor of the government to grow the price a little bit. Of course, it's come a bit too late. We do see that the impact to us should be in the range of 75 to 100 billion on the top and the bottom line. What's more important is this makes some procedures which were very difficult to deliver earlier. Now, it seems that they become from a negative margin to at least a zero margin kind of a business.
Got it. So basically, to clarify, the 75 to 100 billion incremental revenue that you mentioned is just purely from the higher tariffs.
Yes, we do see that this impact will be in the range of 5 to 8%. Exact numbers will come by in the first and the second quarter, Ari. But what we see, because it all depends on the mix as well finally, right? And it's very difficult to ascertain the mix so much in advance. We do see an impact of 5 to 8% favorable during the year on account of the BPJS business.
Got it. Appreciate the color there. So it seems like there's a tailwind on the BPJS side while the private side is still being boosted by the corporate clients.
Insurance too. Corporate and insurance both are very robust, and I don't see any change in that in the coming year as well.
Got it. So basically looking at the very strong result 22, and then double-digit top-line growth uptick, how do we see the sustainability factor, right, on these growth drivers and also the margins uptick looking in the next few years?
So interesting question, and I think I'll take a part of it. Maybe Carol and Daniel can add. When we look at our business, we look at our industry, there has been a huge volatility in terms of performance that we've seen across the region. If you see hospital companies across the region, forget Indonesia, there's been huge volatility. Daniel alluded to this, that we've had a stupendous year last year. 21 was a fantastic year for us. And when we started 22, we were unsure, will we be able to sustain that performance? Because 34% of our revenues in 21 came on account of COVID. And that's massive, right? And building back the base case is easier said than done. Our first and second quarter was not as robust as what the third and fourth quarters have been. But what we've seen that when we stuck to our strategy, and it was very painful, by the way, I remember you asking a question as to why we are not taking COVID patients in every single hospital in Jakarta. Because we wanted to do what's right. And what's right meant that keep your centers of excellence for patients who need it and do not contaminate those hospitals by bringing in COVID. Very difficult thing to do because the easy flow was getting the COVID patient in, right? But the hospital that you're sitting in, Kebonjeruk, Lippo Village, a difficult call, but I think the management did take the call to keep them clean. And because we kept them clean, we were able to serve patients who would have traveled abroad for healthcare if travel was not restricted. And when they started to come into Siloam, it became a habit. Because if you can get care closer to home, what better, right? I think that's really helped us, one, give the right perception to the market that Indonesia has really evolved over the last 30 years. It's not the same healthcare system. Siloam, of course, becomes a preferred choice for all our customers. And that has provided significant sustainability at the back of our base business growth. Last year has been fantastic. We've been able to recover our business, grow our margins on account of the right business that we do, which is the base case business. Needless to say, with the loyalty partnerships that we've built over these last 4, 5, 6 years, the network that we have over 29, 28 cities, which is unparalleled, nobody covers Indonesia like we do. I'd argue this is a perfect case for business sustainability. We've stuck to our strategy, which we outlined 4 or 5 years back. It's a 4-pillar strategy, and I think that seems to be working well for us. Carol, would you?
Thanks, Varun. I'm just building on what Varun has said, and he shared a lot. I don't think that the performance that we're showing for 2022 or quarter 4 is performance that is built overnight. We have been talking about Siloam 5.0 over many, many quarters and consistently updating and consistently showing results. And so you see that quarter 4 is not an aberration, right? I mean, it's not a one-off. And therefore, the answer to your question, yes, we do believe it's sustainable. We believe that, again, we are in a market and an industry that continues to grow. We can also talk a little bit about some of the changes in this industry with the RUU Kesehatan coming up, which is very exciting, which we do believe will boost growth in this industry. We're in a population where healthcare is very much underpenetrated, and we know that when some of these key factors are unlocked, that we would be in the right position to take advantage of this and be able to serve more people. So yes, I do believe that it's sustainable. But besides that, I don't think that we're just riding off of a wave. We continue to be deliberate in implementing initiatives for growth as well as for cost management as well. And I think Daniel can talk about some of those cost management initiatives that we've been rolling out.
Management initiative, there's been quite a few I touched on previously. But for example, we're in regard to the material cost savings. This year, we've embarked upon a significant review of how we procure for our equipment as well. And along with our, for example, the hemodialysis machines that I mentioned earlier. Again, I won't repeat it, there's a savings realized, but that has gone through a long process for us to try to A, consolidate the volume, understand what every hospital is buying, B, try to standardize, I guess, the spec in terms of what people buy. I mean, we did that with drugs, and we are now doing that with equipment as well. After that, going out there aggressively and negotiating with vendors. But you know, the efficiency in procurement, I think, is one thing. The efficiency in the working capital is another that you would have noticed. We have worked aggressively to bring down inventory days. But we have worked aggressively to bring out receivable days as well. So that has really helped a lot in the working capital improvement. And these are kind of all ongoing initiatives that the management is taking. I mean, not to mention that we also have currently an OPEX efficiency initiatives, whereby we have set ourselves an internal target of at least 100 B of OPEX savings. We are going through and looking at the structure of organizations. We are looking at the way some of our contract services with regard to cleaning, with regard to security are structured. We are looking into some of our initiatives with regard to waste management, paper, how to reduce paper, and so forth. So this year, we set ourselves a target of 100 B of OPEX efficiencies that we should achieve by all this initiative that's been undertaken. You will see that a lot of initiative that's been rolled out in office, in our hospitals, with regard to the single queue, with regard to the electronic medical records, with regard to how prescriptions are done. Those obviously have the primary benefits of improving patient's experience, but it also has a side benefit of reducing costs for us. For example, radiology, we are going to basically go full electronic. That reduces the cost of getting CDs, getting big envelopes, to put all those radiographic samples in. And also we've embarked upon a lot of ESG initiative, looking at electricity savings, looking at how chillers are configured within our hospitals. Those obviously has a positive environmental impact, but also has a positive impact on our cost management as well, which is why, as you can see from our results, margins do see year-on-year and quarter-on-quarter improvements. Yeah. During the COVID time, the margin improvement was on account of COVID having higher margin. But the fact that after COVID, we're still able to maintain the margin basically is a testament to what management has been doing diligently to look at avenues to improve efficiency and cost management. And also from Varun's side, which he has alluded to earlier, the improvement in case mix, in sort of payer mix, going into more of the corporate insurance, obviously would have a higher margin contributions as well. And those, I think, has all contributed to the bottom line.
Got it. Thanks a lot, Ibu Caroline, and also Daniel for the color there. So just last couple of questions from my end before we open to the floor. So the next one is in regards to the CapEx plan for 2023. Can you please elaborate on the strategy this year and how many hospitals is Siloam planning to open? That's the first one.
I think officially, Carol? I'll answer from financial perspective first, and then maybe Carol and Varun can add more on the business perspective. We are certainly still looking at expanding and opening new hospitals, and we are continuing to invest in our CapEx as well. I think you should look at, with regard to the routine CapEx to support business operations, we're probably looking at about 700, 800 B for that. And probably another 700, 800 B on top of that to support what we call strategic initiative, which basically includes the opening of new hospitals, both greenfield and brownfield expansions. You do see from our cash flow that we are now generating a healthy kind of 1.6 trillion plus operating cash flow a year. And in addition to that, Siloam currently is in a net cash position. We have close to no debt except for some working capital loan that we take out. That all put us in a very strong position financially, to look at strategically and expanding our operations. But officially, we haven't changed our guidance in terms of 1 to 2 hospitals a year. But obviously, if the right opportunity presents itself, we certainly have the capability to be more aggressive in our expansions. Maybe I'll let Varun and Carol comment more on this.
We want to make sure our facilities are kept up. We continue to do refurbishment for medical equipment, for our buildings. We plan to expand 1 to 2 hospitals a year, which we've been saying for the past few quarters, and we'll have more information on that. But we are also expanding in existing locations. Now, the beauty of expanding in existing locations is that we have the clinical talent, we have the patient base, we have the reputation, and all we need is more space to grow. And so that's amazing because that you can really see a heightened impact to patients. We can suddenly serve more patients, and the doctors are obviously happier, and the patients are also happier, but it's probably the best kind of investment as well, right? That incremental investment gives us so much more for return for our investment. Now, some examples where we've done this is, number one is in Makassar. an amazing hospital, amazing clinical talent, very, very strong specialists, and has become a referral hospital not just for the city, but for the region as well. And so we are investing in a second building next to the main building. We're also doing the same in Purwakarta that oftentimes gets overlooked. It's not the biggest hospital, but it's very productive with its staff, very productive by meter square. And so it's just really bursting at the seams. And so we've also done an expansion there so we can see more patients. Sentosa is another one in Bekasi. Now, we're also, another category is expanding facilities related to our clinical programs. So we touched on our radiotherapy expansion. So we've signed 10 radiotherapy machines with Varian, and we will be executing that over the next few years. We are building right now, three projects in parallel for Linacs, bunkers, and a few more to come, because we want to install 5 more Linacs in the next 2 years. And so these are some of the expansion programs that we're doing, which are very exciting. We also continue to invest in our systems and IT development. Now, oftentimes these investments are seen as non-revenue generating, but they are the investments that add to our sustainability. And every time you see that there's improvements in the margin, efficiency, patient experience is better, it's due to these kind of investments as well that we do diligently put money aside for, so that we are sustainable and we continue to improve our offerings to our patients. Oh, we forgot the cath lab. So we're also adding a second cath lab in LV. We're adding a second cath lab in Denpasar. Again, 2 locations with amazing clinical talent, and expanding clinical related facilities is just going to help everybody do better. So that's another example.
Got it. Appreciate the color there, Bu Caroline. So speaking of which, any particular center of excellences that will be added this year that will be an exciting?
These clinical programs and centers of excellence, I mean, it's a long-term journey, right? So you can't really say, oh, we started something and it blossomed in the same year. That's not how it works with clinical programs. And that's why we're in such a position to develop these clinical programs, because we've been doing this for the past few years, and now it's time to take some of these programs to a new level. And so one theme that you'll hear from us again and again is that we're not short-term players. I'm not going to tell you, okay, one thing that I'm going to do today that's going to yield me something next quarter. I mean, that's not how it works in healthcare. And so sustainability and continuity is an important thing. So for clinical programs, we have, like we have shared, every single hospital will have a clinical expansion program that they work on, which is always a multi-year program. Now, we've identified on the group level that there are 3 or 4 clinical programs that we want to give adequate focus to in 2023. Besides oncology, where we are very strong in, we want to focus in on 3 clinical programs, which is mom and child, orthopedics, and digestive, where we want to improve our presence and our offerings because we have the clinical talent and not the other way around. We believe that these programs we've incubated for the past few years, and we are in the right place and the right time to take this into a different level. So you'll see us talk more about it. You will see us invest a little bit more on it and bring our doctors to light a little bit more. Now, as orthopedics especially comes the heels of our Mampang COVID hospital, which we have transformed a few months back to become a general hospital. And we are fast-tracking it to become an orthopedics hospital, comprehensive offerings in orthopedics, where out of the 8 subspecialties in orthopedics, we have 6. And so it really is going to be a one-stop comprehensive orthopedic center for Jakarta, which is much needed. We also would like to highlight some of the clinical programs that we have seen a lot of success. The first one is our IVF blastula program. So we have 2 fertility centers. One is IVF blastula, and the other one is in our LV hospital. Now in blastula, we've seen 150 pregnancies in, I think, less than 2 years, which is incredible. And the rate of success for pregnancies is at 53%, and I think that the global average is at, what, 35 to 45% of success. So we definitely are a notch higher above the global benchmark for pregnancy success. Also, another one is our kidney transplant, where we did a grand launch following the formal acknowledgement of the Ministry of Health of our kidney transplant program. We have done 200 and how many have we done now? I lose track because every week they add so many more. So I want to say 250. 250. So I want to say 250, but that number keeps changing every week. That's why I lose track because we're doing even more every week. Per week, we're doing more and more. And these clinical programs I have to credit to the very strong teams that we have. And because these teams are so strong, our job is the easiest because our job is just to support them and make sure this, the program develops well. Now for the kidney transplant as well, we have a 5-year survival rate that is similar to global benchmark. And so we have confidence that we are on that international standard care. And every single clinical program needs to be at that level. Every single center of excellence needs to be at that level, and we do track outcomes. Thank you.
Thank you, Caroline, for the very interesting color there, and then good to get a better sense of the Siloam's near-term and also medium-term growth drivers. So with that, we're going to be opening the floor to questions, and then we're going to start with the participants joining us physically here. Please raise your hand, and we're going to give you the microphone.
Thank you for the clarification. Could you share to us for the capex split of 700 to 800 billion for this year for the strategic expansion? Could you split which one for expanding existing hospitals and which for the new hospitals? That's the first question. And for expanding existing hospital, could you share this hospital, what kind of occupancy rate you're seeing in this hospitals, like in Makassar, and I think you mentioned about Tegal and everything. So that's the second question. And I think the third question, could you also share about how much the provision for the reversal in the provision for COVID in second half of this year? I think I'll start with 3 questions first. Thank you.
Maybe let me these questions. The first, just to clarify, the capex. When I say 700 to 800, there's 700 and 800 to be spent on existing hospitals. There's another 700 to 800 to be spent on strategic and new hospitals. Yeah, so it's not as if the 700 to 800 I need to split between existing and new hospitals. Is 700 one lot and 700 one lot. Yeah. So with regard to existing hospitals, generally, I think this is also to answer another questions raised in the forum as well. But when occupancy is around about 70-75% level, that is when we then look at expanding. We do feel that a 70-75% occupancy is what we consider full, yeah, quote unquote, because you will never reach 100%. But due to obviously it's same as a hotel would never have 100% occupancies. So that is the question of the capex. With regard to the provisions, again, coming back, it's not specific numbers we release. But suffice to say, as I mentioned before, but even if you were to adjust for that, the EBITDA margin is still well above 25%. So it does factor into the margins in the second half of 22, but it is not so significant as to totally distort it.
Daniel, just adding to the last two questions Daniel's answered. One is on the occupancy side of it. So occupancy, clearly 75% is the benchmark when we start to think about developing more capacity. But capacity investment is not limited to occupancy all the time. Sometimes it is to develop clinical programs as well. We need completeness, as we've been speaking about in the past. We need completeness of programs, and that allows us to go well beyond occupancy, because the moment we add complexity, that gives us the ARPOB. And that is something which we strive for. If you look at Makassar that Carol alluded to, we are not only growing because of occupancy, we are also growing because we want to add a center of excellence, which is oncology there. We are bringing in a linear accelerator, which will be the first probably in the region. So all of that will have incremental revenues coming on account of not occupancy, but outpatient, OPD. So the OPD to IPD mix starts to tilt in favor of OPD, which is the best thing to happen to a hospital. If you can take the OPD contribution of a hospital from 25-30% to 40-45%, can you imagine you've impacted the ARPOB by that percentage? Yeah, so that's another very important point I wanted to add to what Daniel said. And I think the other question Daniel's answered a bit in terms of what is the reversal impact. But I think more than reversal, we'll be giving you the throughput impact as well. You'll be positively, I mean, it's a positive flavor that our occupancy, our operational metrics in third and the fourth quarter have grown, and fourth has grown over the third quarter. So that is a direct one to the revenue as well.
Sorry, I want to ask regarding the first question. So the 700 to 800 billion, the first 700 to 800 billion is the maintenance capex. It includes the.
No, so there's capex related to existing hospitals and capex related to new sites and strategic projects. And so the first batch is to do anything to do with existing hospitals. Now, part of that is to maintain the revenue, to do refurbishments and all of that. Part of that is for new clinical programs, and part of that is also capacity expansion in that bucket. And technology, yes. Yeah.
If I may, our capex is a happy state currently, because Carol alluded to this. Every time we are now investing in our existing setups or existing hospitals, our payback periods are so short that sometimes it's a payback in the same year. So it's no longer an investment that's going to yield over years. It's an investment sometimes it yields over months. Number two, the moment you complete the program, you don't lose the patient. If you identify through an internal medicine that the need for cardiology, neurology, or oncology prevails, and if you're able to service that within the same four walls of the hospital, you're able to retain the patient who's going to give you much more. So I think when we talk about incremental capexes within our hospitals, we're also looking at it in a very strategic way. And that's our clinical strategy vertical that we've been talking about for the last 3-4 years. So the structure that you all saw that Carol presented across the 8 specialties which we keep in focus and the 4 centers of excellence that we will try and drive for this year is all based on a very structured piece of our thinking. Yeah, thanks.
Okay, thanks for the question, and also Vern for the color there. So just a follow-up to the to that question, what's the typical payback period for, let's say, an advanced medical equipment? Because I understand that Siloam will be investing more in these.
I should have seen that coming. The moment I said that the payback is a few months, I knew Ari is going to take this question. So Ari, there are 2 kinds of. One is infrastructure, the other is medical equipment. Medical equipment, we don't go beyond about a 2-year payback because there is no infrastructure that needs to be developed. But if it is infrastructure development as well, we'd be okay. The benchmark that we take is about a 25% IRR. A 25% IRR. If it is infrastructure development and we get a 25% IRR on the investment, we're happy to take it. We are very benchmark focused. Daniel does not allow us to deviate from that IRR number. So it's like he's the bank and it is very difficult to get money out of that bank. So largely that's the way we see it. Sometimes we may compromise on this if it is to do with patient safety. That is not then IRR focused. That is patient focused, and we always keep patient number one.
Got it. So about 2-year payback period, and then if there's infra included, it's 25% IRR. Thanks, Varun, for the color. So I'll ask Willie's help to see the Zoom questions because I don't have the Zoom window in front of me.
Yeah, sure. So we have one Zoom question, Pak Daniel, Pak Farid, and Bu Carol. So it's about yeah. So a question from the Zoom from Martin Lechner. Does the positive 2022 results trend continue in the first quarter 2023?
So we're not talking about the results yet or the financials yet on 23, but from an operating metric standpoint, we are now in the middle of March. We've seen that, yes, the operating metrics have continued, occupancy has continued, OPD volumes have continued. In fact, on account of our digital interventions, we've facilitated a better number of OPD because we are seeing more and more people after our digital patient channels getting launched through the year of 22. More and more people access Siloam because it's become easier to access. Yes, so broadly, the operating metrics continue to be as good as last year.
Sure. Thank you, Pak. Maybe next question, Pak, from the Zoom as well, from Peng John Yo. How many % of revenue comes from international patient from pre-COVID until 2022?
Very good question, Peng. I must compliment you for this question because this is a multi-year trend that we are seeing and will be immensely favorable to not only Siloam but Indonesian healthcare system at large. So there are two kinds of patients that we see. One who are foreigners residing in Indonesia, and the others are foreign tourists. From a foreign tourist standpoint, it's been fantastic because Bali is packed, and so are we. We are absolutely out of capacity. There was this question in terms of what's our occupancy. I wish we had a few hundred beds in Bali. We'd be much happier. In terms of contribution, our pre-COVID contribution used to be about 1% on account of these two categories, just about 1%. And now, this category contributes about 3% of our revenues. And needless to say, there are a lot of Indonesians who now don't travel abroad and come to Siloam. So that's another category which we don't measure. But from a foreigner or KITAS holder standpoint, the revenue has gone up from 1% to 3%.
Thanks, Pak Farun. Maybe just a couple more questions, but from the Zoom. We have two from Jason. First one, at what level of occupancy would Siloam consider putting more beds into operations? I think we have already answered it briefly, so it's about 75%. And the next question is, can you provide us with an update on how the ramping up hospitals are performing now post-COVID? Ramping up hospitals performance.
Yeah, so let me take the ramping up. Jason, we've already answered a part of your question. I'm assuming you've captured it. 75% is what the benchmark occupancy is, but it's not limited to that. Sometimes we add capacity, which is not only in terms of beds, which could be in terms of clinical infra as well. On the second part, which is an interesting part, I know we used to give you a lot of color in terms of our ramping up hospitals and so on and so forth. We've stopped giving it because it is not relevant anymore. On a blended level, there was a time we used to lose money, and I know we've reported in the past 16 to 17 of our hospitals were on a blended basis EBITDA negative. Now that category is not EBITDA negative anymore. We've started graduating hospitals. So of the 17 that I think in 2019, correct me, Daniel, in 2019 we had 16, 17 hospitals in probably that category. Currently, post-graduation, that category has come down to 9-10 hospitals. And on a blended level, Q4, these hospitals have been EBITDA positive. So is the way we see it. We've always maintained, and I think maybe I'll request Carol to add, this is not only about the profitability of these hospitals. What is awesome in the work that we do, we are able to cater to healthcare needs of patients when nobody else reaches. And that passion drives what we do. Maybe Carol is the best person to talk about it.
Thank you. Yes, we were very happy with the way that ramping up hospitals are progressing, and yes, we are positive EBITDA for these ramping up hospitals in Q4. And maybe a follow-up question is, how did we get them to positive EBITDA? So number one, we've always said that these hospitals are in the right place and in the right market. We would not be in these markets if we didn't think that there was a right market. Number two, it was important for them to have the right model. And number three, it's important for them to have the right management team and execution. So broadly, it's that. Now, it's been different initiatives for different hospitals depending on what the need is. So for example, in a hospital like Labuan Bajo, it's opening a Labuan Bajo International Medical Center for tourists. The need is there. Nobody's doing it, and just by doing that, and also clinical service development, we've been able to push it over to EBITDA positive, that one hospital. Now another one is also Jember, which we've been able to make EBITDA positive because we've been doing a lot of regional marketing. So building our clinical programs and making sure that cases refer into Jember, especially because there's a lot of equipment that is in Jember that is not in other hospitals, such as the MRI. So by really focusing on what the needs are locally and how we can have the right model to reach those needs, like Varun said, we're able to come up with models where we're able to fulfill those needs and serve more people and become EBITDA positive. So it really is a happy state for everybody. Ambon.
Yeah, because the growth.
Ambon is amazing. It's an amazing story because it was a COVID hospital, opened as a COVID hospital, and as COVID subsided, then there was absolutely no base case. I mean, it was at a zero. In fact, it was at a negative because people knew Siloam as a COVID hospital, so we did not have a bring back story because there was nothing to bring back. But within a year, it was EBITDA positive. And now it is doing a gross revenue about anywhere between 7 to 9 billion. So it is by far the fastest ramping up hospital that we have done. And it's because we've learned a lot from the other hospitals and been able to execute the right model, the right programs, supported and brought in the right doctors with the right investment to quickly bring them up to EBITDA positive. And and hospitals that we will open in the future will also follow in this pattern as well.
Got it. Appreciate the call here, Bu Caroline. So thanks a lot, Bu Caroline and Varun, and also Daniel for the very comprehensive insights today. So before we close, just wanted to pass along if the management team has any last comments.
Yeah, well, I'd just like to thank everybody and all our investors and analysts and banks for the support. We wouldn't have been able to do this without all of your support. It really means a lot to us that you believe in our vision and mission and what we do and the way we do it, and continue to be a supporter in Siloam. I'd also like to draw all of our attention to the wonderful doctors and nurses and team of 12,000 staff and 3,000 specialists throughout our system. It's not a small team providing care across Indonesia. We're really proud to be a part of this, and all of this will not be possible if it wasn't for the dedication of our nurses and doctors and our staff every day in the hospital providing the best care that they can. So would like to appreciate everybody who has taken part in Siloam. And we know that as Siloam does better, we will continue to be a blessing to Indonesia and reach more patients and bring healing and care to the nation. So really privileged to be a part of this journey.
Thank you. I think we said it all.
All right, thanks everyone. So we'll close this session here. Appreciate the time from management and all the participants.
Thank you, everyone. Really appreciate you being here.
All right. Thanks, everyone. And with the closing remark from the management, we're going to close the call in 3, 2, and 1.